So let's say somebody comes to me and says, well, Tony, can I get mailbox money out of a CD? Well, we have to make sure we understand the definition and the parameters we're working on. So yes, a CD principal is guaranteed. And yes, historically speaking, while they're paying over 5% now, most of CDs, they've paid as low as 0.5 or 1%, but we have to assume they'll usually pay some sort of interest. But what happens, let's say if we have we'll just take one person, a 65-year-old, and let's say they have $300,000 and they want mailbox money. In other words, the parameter of mailbox money, again, the definition is they want a guaranteed set income for the rest of their lives. So we got $300,000 with the CD, $300,000 with the annuity. So that means at 5% interest, let's say they buy a 1-year CD, that person is going to get $15,000 a year. And let's say they say, oh, that sounds good. That's what I want. No matter what, I want that bank to send me $15,000 a year. Well, we're not going to do all the math now, but let's be honest with ourselves. If these interest rates go back down, and they probably will at some point, I don't know how our nation is going to keep these interest rates this high and service the amount of debt. So they're in a dilemma right now. But let's just say interest rates go back down to 3, 2, or 1%. Well, what's going to happen is if you're taking $15,000 out of a $300,000 account and the interest rates supporting the CD, listen carefully, go down at some point, depends on what the CDs are, but let's say at age 85, if you're still alive, you could run out of money. In other words, the only way they can guarantee $15,000 a year is if they can guarantee for the rest of your life 5% interest on the CD. They're not going to do that. So let's go to the annuity. How does the annuity work? Well, these are called payout rates, all right? So let's say, and we have so many different insurance companies we work with and different types of annuities. Again, folks, this is very conceptual. I'm just trying to show you how mailbox money works when you turn the money over to an insurance company issuing an annuity. Big difference. So a payout rate says, in this case, maybe it's for a husband and wife. What they say is based on your age, we will guarantee $15,000 a year for life. All right, and let's say the insurance company is kind of like the banks over there. They're similar. They're trying to invest money in bonds and mortgages, and interest rates are all over the place over the next, 20 years. And eventually the account that's set up at the insurance company to support those payments, like the bank, let's say it runs out of money. Where you're saying, well, aren't I out of money? Wouldn't I run out of money at 85 under these same parameters? No. Why? There's a big difference because there is a contract. I'm going to circle that. This annuity is a contract. It is a contract, a unilateral contract between you and the insurance company. And the insurance company, listen, bears all the risk. Well, what is their risk? Their risk is they're going to have to pay you money longer than their actuaries thought you would live. So in this case, if this person lives to age 100, it doesn't matter. Contractually, they are obligated to make that $15,000 payment, in this example, to you and or your spouse, depending on who lives that long.
Thanks for watching. We hope you enjoyed that video. If you'd like, check out these other clips. And be sure to hit that like button and that subscribe button for more videos.